Well, everyone's talking about the market slowing down, and no one's really talking about what's going to happen on the other side and how long this is likely to last. Now, of course, we can only be guided by data, but here's something that is really interesting. You know how I've been saying that most downturns last mostly 18 months or less? Well, here's some real data, and I've written this down, right? Your last downturn that was the longest was 2010 to 2012, which was 20 months. And in 2015 to 2016, which was the next downturn, 4 months. Then 2017 to 2019, 19 months. And 2020, COVID hit, 4 months. Now, of course, there was a catalyst that actually slowed that downturn right down, which was the interest rate reductions. Then 22 to 23, it was 9 months. And of course, 24 to 25, just a short 3 months. So looking at all of that trend, and we can go back historically, and it's always been very consistent. Looking at this trend and looking at the current climate where the market is slowing down, the metrics are actually shaping up for some serious growth in the very near future. So the market has slowed down in all states. In fact, Sydney and Melbourne are leading the charge in terms of slowdown, and they've lost over 4% in pretty much the last quarter. Yet, one of the things that has been really interesting is that the rent has actually risen the fastest it has ever in a month since 2019. So your average rent or your average yield is now 3.85%. That's significant. So what this means is now's the time to jump in, knowing that the downturn is going to be short. And then the upswing, if you look at it historically, it's always been very robust. Now's the time to grab a good fundamentals property in an owner-occupier area, wait out the few short months, and you will be well ahead of everyone else that's waiting for social proof to happen before they jump back in. That's your Wednesday Wisdom, and I'll see you again next week.